Hello and welcome to Close of Business. I'm David Chau. Coming up on the program, trade war round 2. Investors brace as financial markets try to navigate Trump's tariffs.
I do think you should expect quite a bit of volatility in the short term.
And how Elon Musk's close ties with the US president are hurting Tesla's sales.
It's an extraordinary situation. In Australia, it has a big impact.
Also on the show, there may be hope for first home buyers as property prices fall slightly in some cities. From imposing sanctions on the International Criminal Court to turning Gaza into the Riviera of the Middle East and sparking a global trade war, it's been a busy week for Donald Trump and a rough ride for markets. Investors initially ran for the exit after the US president imposed tariffs on Mexico, Canada and China. Beijing retaliated with its own tariffs, while the other two nations managed to score a reprieve after giving in to some of Trump's demands. It's also been a roller coaster for investors, and there's probably going to be a lot more volatility ahead. An 11th hour turnaround in Donald Trump's trade war.
We had a great talk with Mexico. I also spoke with Prime Minister Trudeau of Canada, and we had a good talk.
Canada and Mexico have received a 30-day reprieve from American tariffs, but a lasting agreement is far from assured.
Well, nobody's out.
Take a look at the Nikkei right now, opening downside 1.6%.
Take a look at this, the Dow Jones. Oof.
Falls above 2% were common.
And despite a modest bounce, markets haven't fully recovered from the tariff shock earlier this week.
They didn't expect it to come through, certainly not this quickly, and in this sort of unexpected fashion. I do think you should expect quite a bit of volatility in the short term.
Several companies have found themselves in the eye of the tariff storm, like Rio Tinto, which produces aluminium in Canada, and much of that gets sent across the US border. Against this backdrop, hundreds of companies in Australia will report their financial results over the next few weeks. Some investors believe it could turn out better than expected.
The economy is holding up well. Corporate earnings already bottomed, and then we've got interest rate cut coming through, so more lenient, more loose financial condition, which is great for share markets.
According to Money Market, there's a 90% chance the Reserve Bank will cut interest rates this month. And that's despite concerns that Trump's tariffs could potentially drive inflation higher. These rate cut expectations have driven the Australian share market close to record highs. So there's a lot of pressure to deliver strong profits and earnings forecasts to justify their lofty share prices.
One of the key questions for investors is going to be, is there going to be earnings growth for the Australian share market? And that's important because valuations are relatively high.
For the ASX 200, the price to earnings ratio is around 20 times. But people have been placing huge bets on tech companies, with that ratio at 147 times.
So potentially for the tech businesses, there might be a bit of correction in terms of valuation. We don't know when that might come.
They can't keep growing quite at that rate. So I think there's a little bit of anxiety about whether too much good news is priced in there.
In comparison, people haven't been willing to pay so much for materials and energy stocks, as concerns about China's economy have led to sharp falls in the price of commodities like oil and iron ore. However, gold mining stocks are expected to do well.
Gold prices have been at record highs, which means that cash flow is doing very well and dividends should be relatively high from those gold producers.
And the biggest risk going forward?
If the inflation pick up again, if we have interest rates started moving the other way, retailers are going to struggle, consumers going to falter, earnings going to struggle. So I think for that is probably one of the biggest potential risks to the market.
Higher risks, higher returns. That's what this businessman is banking on. Trade tensions between the US and China have certainly ramped up. Beijing announced it will impose 10 to 15% retaliatory tariffs on American coal, oil, gas and agricultural equipment. On top of that, China said it will investigate whether Google has breached anti-monopoly laws, even though that search engine is banned in China. And it added the parent company of Calvin Klein and Tommy Hilfiger to a blacklist. For more on this, I spoke to independent economist Chris Richardson. Chris Richardson, welcome to Close of Business.
Thanks, David.
So, Chris, the US has imposed tariffs on China, which have already taken effect, while China and its revenge tariffs, it will take effect on Monday. So how do you think this will impact the Australian economy?
So far, not much. By and large, China is incredibly important to us. And so push and shove, and that's increasingly what we are seeing, is a risk to the extent that it's a problem for China. But you wouldn't say that what's been announced so far is massively out of line with what was expected. Yes, it could worsen. But Australia, by and large, we're not directly in the firing line when it comes to tariffs with the US. They run a trade surplus with us rather than a trade deficit. It's in and around China and what could happen there.
It's often been said there are no winners in a trade war, but is that really true? I mean, surely somebody benefits, perhaps, for example, Australian exporters?
I would say, by and large, we're looking at dumb and dumber happening around the world. The tariffs are broad-based. If there's a case for tariffs at the moment, it would be rather more specific. To be fair, the global trading system is not, on a level playing field. There are nations, China is the best example, that subsidises its factories and does it by levying indirectly extra charges on its families. And that means it tends to run surpluses over time. And there is a case, right, for change to be made. But the tariffs that are getting thrown around are unlikely to get us there. Australia could be an indirect beneficiary. I mean, there's a reasonable chance that electric vehicles will end up in Australia from China pretty cheaply. There's a chance that those duties that China has announced on American energy exports will benefit Australian energy exports.
And Chris, it's been said by a lot of economists that if the trade war ramps up, then it could lead to global inflation rising. Despite that, the Bank of England has cut interest rates, and there's a lot of talk the Reserve Bank of Australia might cut rates later this month. So do you think these rate cuts would be warranted?
So what you're seeing with the policies out of the new US administration, yes, there are some inflationary risks there. If tariffs add to prices, that's mostly a one-off, though. And I'd say the key thing that you're seeing is a lot of chaos. And chaos comes with a cost. The chaos of what's happening in the US will make families, businesses, nations more careful with their decision-making. That will slow down global economic growth. If I'm the Reserve Bank, and I would call it a reasonably finely balanced decision as to whether they cut or not on February the 18th, I would actually say what's happening in the US might tilt me a little more towards a cut. Those fears over slowing growth in places like China and the world off the back of the tariff stuff would outweigh the inflationary impact.
And the question on a lot of people's minds, how many rate cuts do you reckon there will be this year?
Well, again, I'm not as optimistic as the market is. The market's essentially looking for around 4 cuts. I think 2 or 3 cuts. Again, a flip side of the uncertainty introduced into the world economy by US policy making at the moment is the increase in longer-term interest rates. It just makes it a little harder to do too much at the short end.
And Chris, if there is a rate cut this month, it's likely we'll see a serious ramping up of the election campaigning. And on that note, there's been talk the government might introduce, or is thinking of introducing, a road user charge for people who drive electric vehicles. What do you think of that as a policy?
Very, very sensible. I mean, at the moment we pay for roads with a fuel excise, but increasingly cars won't use fuel, so we need to properly tax around that. Mind you, if that's the sum total of tax reform that we're talking about ahead of the election, and even that's a possibility, then, I would worry that we're not talking about doing all that much.
What other policies could we expect from both sides of politics during the election campaign?
Whatever the Reserve Bank does on February the 18th, it will be the starter's pistol for both sides and their election policies. One thing that's not official yet will be made official pretty soon afterwards. We're getting big federal electricity subsidies, basically fossil fuel subsidies, they will be rolled over for another year of $3.5 billion. The government doesn't want to announce that ahead of the Reserve Bank making its decision. And you will start to see, again, regardless of what the Reserve Bank does, it will free up both parties to make more announcements in the run-up to the election itself.
Well, Chris, thank you very much for your insights.
Thanks, David.
Donald Trump's new best friend Elon Musk has done pretty well for himself, particularly since his wealth over the past year has doubled to more than $400 billion US. But his close relationship with the US president and his tilt towards the far right of politics appears to be hurting Tesla's car sales, which were down 17% last year in Australia, and they dropped by more than 30% last month. In Europe, it was even worse, especially in France and Germany, where sales in January plummeted by more than 60%. On top of that, sales in California, a state which is typically controlled by the Democrats, have been falling pretty sharply throughout all of 2024. It's the US state with the highest number of EVs, and it's where Tesla's headquarters used to be. For more on what's behind this, I spoke to Giles Parkinson, who's the founder and editor of The Driven.
The overall market has not been strong, but Tesla has accounted for more than half of the Australian EV market in the last few years. So when they fall, it affects the rest of the market. We've seen that in Europe also, where the market is probably stronger than it is in Australia. In Norway, for instance, which is already at 96% electric vehicle share of the market and has actually been quite strong in the last month, Tesla has slumped quite sharply. It used to be the top-selling EV in that market. Now it's number 6 or number 7, and we've seen that in France, in Spain, in UK, Germany, Netherlands, Portugal. The share of the number of Tesla sales has fallen significantly, and that really has been attributed a lot to the impact of Musk on his brand. And look, we're hearing that people are walking into other car makers and saying, look, I want to buy an electric car, but I don't want to buy Tesla anymore. And we're also hearing that people who own Teslas are feeling uncomfortable about that and are looking to see if they can either sell and shift to another brand. It's an extraordinary situation because the Tesla products are really quite admired because of their quality, but some people are just finding it really difficult to either buy or retain those cars. There's also issues around inventory. Some people might have been waiting for the upgraded Model Y, which has been the best-selling EV in Australia for a while now and is coming up with an upgrade in 6 months, so maybe some people are delaying their decision on that basis. So it would be wrong to say that Mr. Musk is the only impact on the stock. There are other factors, but I don't think it would be right to say that he's having no impact.
The US-China trade conflict could also spell the end of an era for cheap online shopping. Aside from its tariffs on Chinese goods, the US has closed a tax loophole which allowed online retailers like Temu and Shein to sell their products in America at bargain prices. Kate Ainsworth has the latest.
Shein and Temu flooded the United States with cheap Chinese products after Donald Trump's first presidency. Everyone was shopping online during the pandemic. Then the cost of living crisis turbocharged their popularity. The e-commerce giants took advantage of a tax loophole, which allowed parcels into America under the value of $800 US to avoid import levies. It's estimated customs officials processed over 4 million packages a day in 2024, with goods from Shein and Temu accounting for more than 30%. The sheer volume of shipments was a problem, as authorities couldn't check them all, allowing illegal drugs like fentanyl to slip through. The tax loophole, known as the de minimis exemption, has now been closed, meaning Shein and Temu products are subject to the new 10% tariff, which comes on top of past tariffs levied against China, which experts say now amounts to about 20%. So Americans ordering $100 worth of their products would now fork out $120 because of a $20 import duty, which will only add to inflation in the United States. Donald Trump has been threatening tariffs for a while, giving these companies time to plan. Many popular products have already been shipped into America and are sitting in warehouses waiting to be sold. Temu is also shifting away from marketing itself as ultra cheap to offering more affordable prices. Shein and Temu's main US rival, Amazon, would also be hit by the tariffs and tax decision, as many of its sellers come from China. But its founder and CEO, Jeff Bezos, could seek an exemption, like President Trump granted Apple for iPhones. That would give the US tech giant an advantage over Temu and Shein, which are rapidly expanding into other countries, including here in Australia.
Now, onto the share market. There were some fairly heavy losses when the week began, but investors managed to claw them back for the most part, as they're still hoping for a peaceful resolution to Trump's many trade grievances. For the week, the All Ords slipped by just 0.1%, while the ASX 200 did a little bit worse, down 0.2%, but they're still trading close to record highs. And for a wrap of this week's market movements, I spoke to Kyle Rodder, a senior financial market analyst from Capital.com. Hi there, Kyle. There's been a lot of optimism in the markets despite all this trade war volatility, huh?
Yeah, certainly. I mean, I guess we're climbing the proverbial wall of worries, investors often say, and, the ASX 200 was a great example of that this week, where we had that kind of air pocket on these trade war concerns, obviously between the US and Mexico and Canada, quickly relieved, and then, subsequently we almost reclaimed the full drop and came very close to record highs again for the ASX 200. So despite these trade war fears persisting, and they probably won't go away, anyone around for Trump's first term will know that things can change pretty quickly. For now, market sentiment is pretty positive, if not hopeful that the trade war won't deteriorate much, and we'll continue to see these sort of strong returns on equities going forward.
So could you run us through which parts of the market did well and not so well?
Yeah, well, quite remarkably, we're seeing a lot of strength coming through the financials at the moment. Partially that's to do with bets of the RBA being able to cut interest rates in a couple of weeks' time. We also saw some signs of life in some other domestic sensitive areas of the market, which are interest rate sensitive. The ones that were really kind of quite noteworthy for their underperformance was the energy sector. We did see a bit of a drop in oil prices. It was somewhat precipitated by some of the policy announcements from the Trump administration over the last couple of weeks about this whole notion of drill, baby, drill. But on top of that, there's still concerns about the global growth backdrop ex the United States. And there was also a very large build in US crude oil inventories, which sort of supports some of the reportage or analysis done by OPEC and the EIA that there will be a modest glut in the oil market going forward. So we did see some weakness coming through the energy landscapes.
So Nick Scali released its financial results while Domino's published a trading update. So their announcements, what do they say about how consumers are faring?
There probably wasn't a common thread between the two as far as the macro story there. Nick Scali showed that revenues were a little bit more resilient than probably expected, and perhaps indicates that households, while obviously doing it tough, and sales were relatively weak compared to a year ago for Nick Scali, things weren't quite as bad as thought. Really, the stock rose, or Nick Scali's stock rose, really on the basis that profits fell by much less than expected, and that's more of a kind of cost management story related to that business. Obviously, like any other business at the moment, dealing with high operating costs, and also the costs related to this kind of expansion into the UK. The Domino's Pizza one was probably even more interesting. A big rally on Friday, up over 20%. That was more about sort of efficiency gains being priced into the market because of these closures of 200 plus stores from Domino's, really changing strategy actually away from this kind of build them and they will come model to we'll build them where customers want them sort of model. So investors really embrace that.
And looking forward, Commonwealth Bank will release its results next week. And it's the world's most expensive bank when you compare the price to its earnings. So how outstanding does its profit need to be in order to justify its valuation?
It has to be really, really good. And I mean, it has to be said that, a lot of the reason why CBA shares are rising the way that they have recently isn't to do necessarily with the bank's fundamentals, but more due to the fact that we have seen strong momentum behind the stock. Retail investors tend to love it, and for good reason. Over the last year or so, it's up by about 40%. But also it tends to enjoy a lot of passive flows from global investors when global market sentiment is good and want and investors want exposure to the Australian stock market. CBA's multiples tend to rise. So we've seen this happen in the past, and actually it's tended to be a bit of a harbinger of a sell-off around earnings results, because it's just so difficult for the bank, whatever it does, to release a set of numbers that justifies these high valuations. So it could be a really fascinating one to watch, maybe arguably obviously the risk is a bit asymmetric and skewed to the downside as a result, but will be certainly crucial for the market next week because, as we noted before, it was one of the big reasons why the ASX 200 performed well this week was the strength in the CBA at record highs, but also the strength across the broader banking space as well.
And for reporting season next week, there will be a lot more companies reporting their results as well. So what are you expecting to see?
Well, again, it's kind of almost a similar story to the CBA story to some extent. We've got the likes of CSL and a few other big names reporting. But, one knock on the ASX 300 quite recently has been that, we are seeing it hovering somewhere near record highs and, over the last 12 months or so performed reasonably well. But unlike other markets, most pertinently the United States, it hasn't really been followed up by the same level of earnings growth. And, we are obviously dealing with some fairly significant earnings headwinds when we're talking about, a fairly weak domestic economy. That sort of affects things like the banks and the consumer space, but also some weakness in China, which is keeping mining profits fairly subdued, and again share prices there fairly sluggish as well. So it's going to be a difficult one, I think, for the investors this earnings season because, again, prices are pretty high, valuations are pretty rich, but we're not really seeing yet evidence of earnings to sort of justify those levels.
All right, so the pressure is on to deliver some really amazing results from these companies. Kyle, thanks a lot for your insights.
Thanks.
To the housing market now, and property prices remained steady across the country in January. Many cities are experiencing a slowdown or declining values, making it easier for first home buyers to enter the market. Rachel Clayton reports.
In the heart of the nation's most expensive city, an apartment is ready to sell. But no one is willing to pay the price the owner wants.
What we've opted to do is to continue the negotiations, but privately and behind closed doors.
In the last day or two, it's just fizzled, so I don't know what's happened.
It reflects a cooling housing market across much of the country.
There's a clear trend of slowing in the pace of growth. Overall, a gradual transition to more of a buyer's market with fewer sales and demonstrated demand and stock levels starting 2025 higher than where they were at the beginning of last year.
Prices remained steady in January, but were still up 4.3% for the year. The monthly gains were driven by Adelaide, Darwin, Perth, the regions and Brisbane. But values in Hobart were flat and they went backwards in Sydney, Canberra and Melbourne.
In a place like Melbourne at the moment, lots available at that sub $750,000 price point. There's a lot of stock out there. Interest rates are high, but this year we are looking at seeing maybe 3 or 4 rate cuts. So home loans will also get cheaper to pay off.
A reduction in the cash rate would probably massively boost consumer confidence that it is a good time to buy, and it would increase borrowing capacity, which would put upward pressure on values.
The slowdown in prices has helped first home buyer Sophie Bukers get on the property ladder.
We've been living in my parents' flat for about 4 or 5 years.
The 25-year-old and her husband had help from their parents and grandparents to buy an apartment in Sydney's northern beaches.
It definitely allowed us to get into the location that we really wanted, which bumped it up from a 1-bedder to a 2-bedder sort of price range for sure.
According to a rolling survey of 52,000 Australians by Digital Finance Analytics, more than 60% of first home buyers relied on money from their family in 2024. 80% received cash from their parents and 12% from their grandparents. They were given an average of $112,000 to buy their first home.
Some experts say the bank of mum and dad has become one of the major factors underpinning house price growth, giving the current generation of new buyers a springboard into the market.
The fact is that if you don't have those sorts of connections in your family, it's very hard to get into the market.
The bank of mum and dad dynamic in Australia is strong and getting stronger. It's a new reality. It's certainly part of the landscape now, and it's not going away.
$3.5 trillion is set to be handed down from older to younger generations in the next decade, according to NAB.
I think in this economy and situation, if family are able to help out, that will definitely be a given for my generation and probably going forward as well.
Keeping wealth in the family.
The Bank of Mum and Dad is not just being used to fund home deposits. Many Australians are also getting help with their mortgage repayments and even their living expenses. Figures from UBS show the payments often extend into hundreds of thousands of dollars. And economists warn this could be propping up inflation. Here's Rachel Clayton again, who's been very busy.
Over coffee, these mates chat about how they've helped their children buy homes.
Let's just say the new phrase of the Bank of Mum and Dad did get a run with both our kids. So, yeah, of course we helped when we could.
Cost of living is a constant with them, even though they're doing quite well and the future looks bright. But, things have got too expensive, whether it be going to the supermarket or whatever, and they're realising that, and we're realising it. I think everybody is.
A UBS survey suggests payments from the Bank of Mum and Dad to children are regularly above $200,000. 69% of financial help came from parents, while 14% were helped by grandparents. Of those who received cash, about 25% used it to buy property and 28% used it to pay mortgage repayments. But the majority spent the money on living expenses.
That's why the consumer in Australia has been able to weather the interest rate hikes over the last few years far better than we would have thought, because they're getting help with their weekly bills and food and utility expenses.
That's something this mum of two knows all about.
Do they ever need your help?
Oh, yes. Yes, they do sometimes. Yeah, it's financial, and it could be something like the cat needs some dentistry done and they don't have that spare cash lying around. Just things like that. Could be furniture, buying a brand new phone.
The Bank of Mum and Dad is also helping Australians hold onto their homes.
The rate hikes that the RBA has put through over previous years out in the suburbs have not been quite as impactful, because regular mortgage holders are receiving these support payments from other family members. It seems to be something that will continue on from generation to generation going forward.
About 30 years ago, older households had about 3 times the wealth of younger ones. Now that gap has widened to about 5 times. With longer lifespans, many are choosing to pass on wealth now rather than waiting until they die.
That could increase the divide in Australia. So, even things like private school fees, anecdotally, healthcare costs, rent, meeting, mortgage repayments. That, I think potentially could widen the divide.
Who knows, hopefully one day she'll be able to look after me.
Leaning on family when times get tough.
And that's all from Close of Business. For more, you can head to our website, and you can always catch The Business on Monday to Thursday evenings at 8:45 Eastern Daylight on the ABC News Channel and iView. I'm David Chau. Thanks for tuning in.